Today we are going to be accounting for adjusting entries. Adjusting entries are the entries of revenue and expenses that haven't been recorded by the business, as businesses will receive accrual revenue and incurred expenses, but not actually record them until they receive the money or pay the expenses. For example, let's take a look at David's squeaky clean windows. His glass repairs business works through the process of completing the service before obtaining the cash. This is relatively risky for him, as sometimes clients will not pay and he will have to account for that with his allowance for bad debt. But this business has issues with adjusting entries in their journal. This reflects poorly on the business, as T accounts, ledgers, and all financial statements are produced with inaccuracies. Now let's break it down. One example of the monthly accounts for the business. David Squeaky Clean Windows this month did a large job for Claire's Cafe, as a whole wall of glass paneling had been shattered from a break-in, receiving $5,000 for the service. David had initially debited his accounts receivable and credited service revenue when he billed his customer. But at the end of the month, once the job was completed, the customer paid the full amount. David then needs to debit cash and credit service revenue, as the cash has been received, increasing the service revenue. To explain this further, the revenue account has a normal balance of credit, and because the business has received all cash for the service completed throughout the month, service revenue is credited. I hope the accountants of this business are now understanding of possible adjusting entries through this example. Thank you.